Hi there, this is Bruno from Spainguru.es, your portal and community for Spanish immigration, and today we're going to talk about Spanish tax residents, an expert's guide to filing taxes in Spain. This was updated just yesterday, November 2022. When you move to Spain and become a tax resident in Spain or have income in Spain, you're subject to Spanish taxes. If you're a tax resident of Spain, then you'll be liable for income tax and capital gain tax on your worldwide income and gains, and wealth tax on your worldwide assets. Below, we'll describe the basic concepts you should be aware of in order to ensure compliance with Spanish tax obligations and avoid any issues and fines that could cost you time and money. Tax fines and liability are high and severe in Spain, so it's essential to know and comply with your tax obligations. First question: am I a Spanish tax resident? You'll become a Spanish tax resident under Spanish internal legislation if you meet any of the following conditions. More than 183 days are spent in Spain in a one calendar year. These days don't have to be consecutive. You become resident irrelevant if you take out a formal residence permit and whether you are registered for tax purpose in Spain. Temporary absences from Spain can be subtracted unless it can be proven that the individual is a habitual resident in another country for more than 183 days in a calendar year. Days of arrival and days of departure do count as days of presence in Spain. Number 2. Spain represents your center of economic interests. For example, if you have your main source of income and assets in Spain, or your business in Spain, or your professional or economic activities are in Spain. And third, your center of vital interest is in Spain. For example, if your spouse, not legally separated, and your dependent minor children live in Spain. In this case, you are presumed to be a Spanish resident, even though you may spend less than 183 days per year in Spain. And here you can see a very clear chart to determine if you're a tax resident. Okay? So I'll let you guys look at it. As you can see here, there's questions you can ask yourself, like, have you been in Spain for more than 183 days? Yes, you're a tax resident. Are you a Spanish national moving to a tax haven? No. Is your center of economic interest in Spain? Yes. And then you will be a resident. Is your center of economic interest in Spain? Yes, you become a resident, etc., etc. I'll leave the link in the video below so you can see it more clearly. Alright, when does the tax year start and end? The tax year is the same as the calendar year in Spain, for example, from January 1 to December 31st. Where are my tax obligations if I'm a Spanish tax resident? Alright, once you determine if you're a tax resident in Spain, you're liable for taxes on your world income and you must inform the Spanish tax authorities, or Hacienda, of the assets that you have abroad. Now let's go to personal income tax, which is called IRPF, Impuesto sobre la Renta de Personas Físicas. In Spain, income is split into general income, renta general, and savings income, renta del ahorro. Savings income include capital gains. After being calculated per the rules for each income within each category, the total of general and savings income is termed the gross taxable base, base imponible. After any deductions and allowances, it is then known as the net taxable base, base liquidable. Spanish residents are taxed under worldwide general income at the progressive scale rates. The income tax scale rates are made up of the national tax rates and the community tax rates, which are set independently by each autonomous community, for example, Madrid or Catalunya or Andalucía. Generally, the top combined rate of tax is 45%, but can be higher in some communities, for example Andalucía, if they have increased the regional tax rates applying in that region, and many regions have done so. Anything not categorized as savings income is included as general income, including all earned income. that is, salary, self-employment, and pension income, rental income, any imputed income, and gains not made on the sale transfer of assets such as from gambling, for example. Tax rate on general income 2022. This is a general table and each comunidad autónoma has its own table. As you can see, it's a progressive rate that applies to the different incomes that goes from 0 to more than 300,000 and goes from 19% to 47%. This is as of 2022. Tax rate on savings, and this is again 2022. The worldwide savings income of residents in Spain are taxed progressively at the following rates. And it goes from the first 6,000 euros up to 200,000 plus and ranges from 19% to 26% for residents, but for non-residents it's 19%. Savings income consists of dividends, interests, income derived from life assurance contracts, purchase annuity income, capital gains on the sale or transfer of assets. Exemption for income earned abroad. There is an exemption of up to 60,100 euros per year for salary income earned by workers who work abroad but remain tax residents in Spain, provided certain requirements are met. Special tax regime for expats coming to work to Spain. This special and extremely beneficial tax regime is commonly known as the Beckham Law. Through this optional tax regime, a non-Spanish tax resident who moves to Spain as a consequence of an employment contract can apply a 24% tax rate, be taxed only on Spanish source income, that is, be treated as a non-Spanish tax resident, and be exempt of Model 720, which we will going to talk later on, provided certain requirements are met. And here in the article, you also have a link to a question and answer. Am I eligible for the Ley Beckham to be taxed as non-resident while working in Spain? And if you click that link, it will go to this question and answer. But we're not going to go into it. We're going to continue with the more general article. Model 720, Modelo 720. The Model 720 is a merely informative filing, but its content is of special interest for the Spanish tax authorities to exhaustively control taxpayers' assets and their variations. In fact, its oversight is considered a priority in the Spanish tax authorities' control plan. You are subject to Model 720 if you're a Spanish tax resident in Spain and the owner, title holder, representative, authorized person, beneficiary, or have disposal powers of assets located outside of Spain worth more than 50,000 euros. See the assets below, we're going to go through that, and must report the value of these assets. There are three main groups of assets that must be declared in the total joint value of the groups exceed 50,000 euros. 1. Funds in accounts in financial institutions, such as funds can be held through the figure of the owner, co-owner, representative, authorized, or beneficiary. The valuation of the funds should be the highest of the balance at December 31st or the average balances at the closing of each quarter. Securities, rights, insurance on income deposited, managed, or earned abroad. Life insurance policies and temporary or lifetime income generated from lending money, rights, or assets to foreign entities are included, while pension plans and stock options are excluded. 3. Real estate and rights over real estate located abroad. So it is worth noting that once the limit of 50,000 euros is surpassed for a group, all assets in such group need to be declared regardless of each asset doesn't individually pass the limit. Additionally, the obligation to report exists where the specific assets are over 50,000 euros, regardless of how many holders or owners there are of a particular asset. Each holder-owner should declare the total balance or value, not the prorated, indicating the percentage held or owned. The reporting period is between January 1st and March 31st of each calendar year with respect to assets held as of 31st December of the previous year. This is for Modelo 720. If you need tax experts, Spainguru recommends tax experts. You will find the link in the description below. If you need help with your filings in Spain or in the US if you're an American citizen. And as you know, if you're an American citizen, you have to file taxes regardless if you're not resident in the USA. Alright, let's continue. Modelo 720, revised penal code. And this is very important because it used to be very hard to miss on your Modelo 720 or to have mistakes. In response to a decision by the European Court of Justice, the Modelo 720 penalty regime has been modified to levels that are much more tolerable. Residents of Spain are still required to annually disclose their offshore assets on Modelo 720. The general penalty scheme created by the Spanish General Tax Law now applies to Modelo 720. The following is a major reduction in the fines and penalties for failing to file Modelo 720 or filing it incorrectly or incompletely. For each piece, set of information that should have been included in the individual's declaration, a fixed monetary fee of 20 euros, and listen to this, before it was 5,000 euros, will be imposed. The maximum fine is now 20,000 and the minimum fine is now 300 euros. And formerly, the minimum fine was 10,000 euros. And there was no maximum. So if you made several mistakes, you could be like paying 500,000 euros and so on and so on. It was really crazy. And this was not a long time ago. I think it was like last year that this changed, actually. Like 2021. If the Modelo 720 is submitted after the deadline, but before the Spanish tax authorities get notice of non-compliance, these fines and the minimum maximum limits will be reduced to 50%. However, keep in mind that if the unreported assets or rights are situated outside of the European Union, the fines will be increased. So, Americans, again, if you have assets in the US, careful. To illustrate how much less severe the new penalties are, consider that under the previous system, a person would have to pay 25,000 euros in fines for failing to disclose a foreign bank account. The fine is only 300 euros going ahead or 600 euros if outside the EU. Importantly, Modelo 720 is now included in the 4-year statute of limitations. This indicates that the Spanish Hacienda or tax authority in Spain cannot impose a fine for more than the previous 4 years. What are my tax obligations if I am not a non-Spanish tax resident? Non-Spanish tax residents pay taxes only on Spanish source of income and capital gains at the flat rate of 19%, subject to double tax treaty provisions, if they are residents in the EU or EEA country. If they are resident in another country, the tax rate applied is 24% or 19% depending on the type of income. EU-EEA residents may also be able to deduct certain expenses not available to non-EU residents. That is, when calculating net rental income on properties held in Spain. Depending on the assets or income derived from Spain, non-Spanish tax residents must appoint a Spanish tax resident individual or legal entity as their tax representative. The reporting period depends on the type of Spanish source income. For owning real estate in Spain, imputación de la renta, the year after titleship. 2. Capital gains income from the transfer of real estate in Spain, 3 months after the date of the sale. And 3rd, other types of income, the first 20 natural days of the month of April, July, October, and January. Double tax treaties, what are they and what are they for? Double tax treaties are agreements signed by two countries which determine how taxation on the same income between two countries is distributed when there is a conflict. That is, when a person qualifies as a tax resident under two countries under the laws of each country, or when a tax resident in one country receives income from an asset located in another country. Spain has enforced more than 94 double tax treaties with other countries, including the USA, United Kingdom, Australia, and so on. It is of great importance to know the mechanisms of this and apply them as they enable us to avoid paying taxes twice. Can I be a tax resident of two countries? No, you can't. If you qualify as a tax resident in two countries, you should apply the applicable double tax treaty, if existing. The double tax treaties between Spain and other countries has a tiebreaker clause that comes into operation if you're a resident both in Spain under Spanish rules and in the other country under the other country's rules. The purpose is to determine in which country you will be regarded as a resident for taxes covered by the agreement. In order to identify which country has preference over your tax residency, you need to follow the following list. If you're a resident in both countries per each country's domestic rules, you are deemed to be a resident in the country in which you have a permanent home available to you. A permanent home is any form of accommodation which is continuously available to you for personal use. It doesn't have to be owned by you. Number 2, if you have permanent homes available to you in both countries, you are deemed to be resident in the country that is your center of vital interest, economic interest, and family members. Number 3, if the test is indeterminate, you're deemed to be a resident in the country in which you have habitual abode, that is, where you carry your habitual life. 4, if you have a habitual abode in both countries, you are deemed to be a resident in the country of which you are a national. Number 5, if you're a national of both countries or neither, the competent authorities shall determine which country has preference. So there's no escape. You have to be a resident of one of the two. If I am a tax resident in Spain but have income or assets in another country, do I need to report or pay anything in the other country? You need to apply the tax treaty to see which country has the right to tax and to which amount, which will depend on your residency and the type of income. For example, income from real estate is nearly always taxable where the real estate is located. If the tax treaty enables a foreign country to tax certain income which you will also have to declare tax in Spain, as Spain taxes on global income, you'll be able to deduct taxes paid in the foreign country in your Spanish taxes. What are my tax obligations if I set up a company? If you set up a company in Spain, the company will be subject to corporate income tax, IS, or Impuesto de Sociedades. Any company tax resident in Spain is subject to Spanish corporate income tax on its worldwide income. A company is deemed a tax resident in Spain if it has been formed in accordance with the laws of Spain, or if it has its registered office or its effective place of management in Spain. A company is taxed on its profits at a general tax rate of 25%. There are numerous tax benefits available, that is, for newly created businesses and small and medium-sized companies. I am a US citizen. Do I need to pay taxes in the US? Yes, as a US citizen, you are required to file federal taxes yearly, irrelevant of where you are a resident. Additionally, you may also be obliged to report foreign assets if you surpass certain limits, that is, $10,000 in foreign bank accounts. Please keep in mind that all this information is provided in this video and article are based on personal experience and internet research and should not be considered legal advice. If you need to contact immigration or tax experts in this case, among other services, you can go to spainguru.com and you will find all the links here for the recommended experts for all the services you need. Spainguru also has several Facebook groups with thousands of members. The most important one is this one, Spain Immigration and Residency Questions, spainguru.es, with nearly 16,000 members as of November 2022. We also have groups for Spanish non-lucrative visa or digital nomad visa. You can also subscribe to our weekly newsletter where we post the top discussions on our community and also blog posts and news about Spanish immigration. That's all for now. Thank you very much for watching. If you like these videos, please give us a like, subscribe to the channel, and hit the bell button. Thank you so much. This is Bruno from spainguru.es. Have a wonderful day. Bye-bye.